let's shift focus to the banking pack. We have IndusInd Bank declaring results today. We have HDFC Bank that posted a steady set of numbers for Q1 yesterday. Profit for the quarter has come in above estimates. It's gone up by around 30% on a year-on-year basis. But let's firstly talk about the top line. You're seeing net interest income, which went up a solid 21% year over year. We're also seeing other income, which grew on a lower base, which grew a very solid 45% year over year. OPEX went up roughly 34%, stayed elevated. That is the expectation, anticipation, and operating profit was not really dented on the back of that. Operating profit went up 22% year on year. In fact, saw 1% jump even sequentially. In terms of provisioning came in lower than expected. Credit costs coming in lower than expected as well. 4,000 crore was the provisioning expectation. It's come in at 2,860 crore. So definitely lower. And therefore, you saw a boost on the PAT, on the bottom line, 30% higher versus the 20% that we had penciled in. On the loan growth front, of course, positive is that the loan growth came in at 16%, deposit growth came in at 19%. And despite that, NIMs did not trim in a big way. So that's one of the other key positives to take away. The GNPA ratio saw a rise of around 5 basis points, absolutely marginal. The net NPA ratio largely flat, just 2 basis point rise there. So stable asset quality. Let's quickly go to that HDFC Bank con call, quickly take in what the management had to say.
Our results reflect consistency of delivery, diligently executed to result in continued momentum in deposit growth of 19% and retail deposit growth of 21.5%, gross advances growth of 20% and net of IBPC growth of 16%. Profit after tax increased by 30%, delivering return on asset in the quarter of over 2% and return on equity of about 17.3%. Deposits from HDFC Limited, as it has got merged with the bank, will have an immediate impact to the CASA ratio because it is a time deposit that comes and adds to us, right? So it will have an impact. The 39% is a long-term average. And yes, that is the kind of how we are opening the distribution to get more customers, to get the more savings account, and reach to those small businesses and entities to get the current accounts also. Loan against share, some of that has already come down, and to the extent that it qualifies in the bank, that is where we will continue to build and nurture. Otherwise, we'll have to run it down.
Right. That was, of course, the management of HDFC Bank. Let's quickly move on and understand what brokerages are saying about this result. JP Morgan continues to maintain an overweight on the counter, target price $2,000 a piece. What they're suggesting is asset quality remains solid. Retail deposit accretion has slowed, but that's not much of a concern. The merged entity's gross loan book has grown well, and they believe that the bank can steadily compound earnings with low volatility. So that's a positive. Let's look at Morgan Stanley as well, maintaining an overweight, target price 21.10 a share. What they're suggesting is strong improvement in liquidity, and focus is going to shift on growth acceleration over the next year or so. You're seeing core operating profit growth strong at 16%. You're seeing sequential deposit growth moderation, but that reflects seasonality. Bernstein also maintains an outperform, target price 2,300 a share. They believe that there are no merger-related one-offs expected in the next quarter, so that's a positive. They don't change any target ranges for loan growth as well as ROA. They believe that the lack of a one-off or idiosyncratic reason to explain the weak QOQ deposit growth may be a bit of a concern. Let's quickly move on. We also have the likes of a Macquarie, target price 2110. They are suggesting that the PAT beat is driven by lower credit costs, and the lower credit costs is offset by higher OPEX. The lower deposit growth is on account of seasonality, not really a concern. Loan growth is driven by CRB, personal and home loans, and the merged entity ROA guidance remains unchanged, which is a positive. They believe that Investec also has a hold. This one is probably one of the few brokerages with a hold rating, target price 1750. They believe that advances growth will likely remain tepid. That's the concern that they have. Core PPOP to remain weak post the merger. and they believe that CASA and core retail LCR deposit growth to be the only likely offset to that. So all of the brokerages on HDFC Bank.
All right, then moving on.